Let's talk about retracements and reversals because it's a very important concept and a lot of people mix them up or misunderstand them. Because spotting them is critically important. The ability to point out the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement or a potential reversal. Now, this is why the focus of today's class is to provide you with the information and knowledge needed to accurately determine whether an asset trend is forming a retracement or preparing for a reversal. So let's start off with some definitions. A retracement. What do you think it is? Well, a retracement are momentary reversals that often occur during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within a targeted asset's price action. Well, that was a lot of words, wasn't it? We'll see it. I'm going to take you over and show it to you on a chart. Okay, reversals are temporary changes in asset's trend that occur over a shorter period of time. Oftentimes, these reversals can last minutes, hours, or days. It just depends on what time frame you are utilizing. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during the asset's price action, like seen in a retracement. So let me pop up some live charts and let's see if we can make this a little bit easier looking at a live chart. Okay, now an asset in a normal situation. Now, let's talk about this. Assets can only move one of three ways. They can move up, they can move down, or they can move sideways. Most of the time, assets are not moving up or down. They may peak up and come down and peak up and come down and peak up and come down, but that's really a sideways action when you look at it. So when we say that the markets are completely random, that is the best way to describe a price movement. It's completely random. But there are certain periods within this random movement of an everyday movement of an asset that the asset will start to exhibit non-random behavior. These non-random behaviors are known as trends. Now, a normal healthy trend will move in what we call higher highs and higher lows. A price trend to actually be trending should be pushing to a higher high. Then when it eases back down, it will make a higher low than the low it was before. It'll push back up to obtain a higher high and reach back down, and it will make a higher low than its previous low, and then we'll move up to make another higher high. And this is the movement of a healthy asset. Now, what you're looking at isn't something I contrived. It's not a photograph. It's not a JPEG. It's not a creative. This is the live Euro US dollar chart. Okay, so I'm not making this up. This is how the euro is moving over the last few days. And what is this? A well-developed trend. Now, these areas where the price is easing off the high, forming the higher low, and then moving back up, this period here is a retracement. It's retracing downward some of its movement, and that's a healthy move, and then it will continue its prior opposing move or the prior trend. Okay. This is what you should be looking for, because we only want high probability trades. Believe me, everybody out there can say, oh, I can jump in here, I can jump out there. But ultimately what you want, and the markets are always offering it, there's always opportunities for well-developed trends and to trade a high probability trade, not a guess or a gamble, within a well-developed trend. Oh, don't want to see that one. Where's my euro? Hold on, I want to share. Okay, let's see. I can't. Ooh, let's see if I can get it here for you here. Okay, look what happened here. Bitcoin. We've all been reading about it in the paper. And what did Bitcoin do? It was trading in a beautiful, developed uptrend. And look at this. And this is my analysis from going back weeks and weeks ago. Okay, moving up, making higher high, coming back, making higher low, higher high, move, and moving in a beautifully defined trend. And we need to understand what these retracements are, because we don't want to keep jumping out of an asset or getting scared in our pants because we see it fall down. We need to be able to determine that it is actually a retracement, not how deep the retracement is going to go, but that it's a retracement so that we can stay in that asset and parlay it all the way to the top or as close to the top. But we also need to understand or figure out where we think the top will be. And then when it goes to form its next burst, how do we determine that that is actually a retracement or a reversal? You know, all of these people that held on to the Bitcoin at that point, you know, Bitcoin fell $10,000 today. Okay. But how would you have known that? Well, if you would have figured out where your retracement points could be and when it flipped from a retracement to a reversal, you would have been right on the money. So early this morning, my analysis said right here, this is where I would start to worry. At 51.8, I would have exited the market, because then I would have been sure this is too deep to be a reversal, a retracement, and it was going into a reversal. Okay. But also here was an indication that we came out right where the top should have been. Okay. Everything worked on the numbers if you believed and understood what you were doing. But what you need to do is you need to be able to understand when an asset is retracing or when an asset is reversing. Well, hold on. Let me pull my. Now, there are some general ways that we could look at some rules on what's the difference between a retracement and reversal. But to be honest with you, these are not things you really easily notice in everyday trade, except candles and volume could help you. Retracements are usually small blocks of traders, and they're profit taking. When Bitcoin, or even when the euro sailed up to 121, almost to 122, it eased back down because at certain levels, certain price points, if we would have looked at them, we knew that people already in the market were selling their, because all of us who set target points, who set up and pre-set up our orders and say, fine, I've made the profit I intended, I'm going to close my position, and set up that close at a specific level. So at 121.94 could have been the level, hypothetically, for the euro. When it hit that level, it triggered lots of sell orders, but they were profit-taking orders. Okay. If it's going to be a reversal, we'll see huge institutional selling. And that's what we saw with Bitcoin. All those guys who bought Bitcoin in the 20s, 30s, 40s, hoping it would hit 50, were riding it out to 50, but nobody else, then they started talking 60, but it was 52, 54, 57. But as soon as everybody realized it wasn't making 60, all of those big guys that had huge amounts of investment and made tons of money took their profit. So what you got was institutional selling. Now, chart patterns, like reversal patterns or candlestick patterns, will help you start to see this. You might see something like, if it's a retracement, indecision candles, where in a reversal, you might see an engulfing candle or three white soldiers or three black crows, depending on which way it's going. But whenever a price reverses, most traders or investors are faced with tough options, because we're not sure if it's going to reverse and come back up and reform that trend, or if it's actually just a retracement. So we can hold throughout the sell-off, which could result in large losses if the retracement turns out to be in a large trend reversal. Now, you say, yeah, I could sit and ride it out. Well, you got to remember you have a couple things facing us. Because we're short-term traders, we're most likely using leverage. Okay. And how much exposure can you carry? If you're trading $12,000 worth of the euro with a couple $100 investment because you're leveraged and it falls down against you, how much can you ride out before the broker's going to give you a margin call or you wiped out the balance of your account? And therefore you have to be very, very careful. Yeah, if you're an institutional bank or a hedge fund that can say, yeah, we don't care. We know Bitcoin's going to go to 65 or 70 in the next couple months. We're going to hold on to it. Well, that's perfectly fine. But you and I can't afford to hold on to it. As most of the time, we're trading it as a CFD or we're trading in a leveraged position, or this is all that you have. And you need to get out because you can't afford to be upside down for 2 months or 3 months. So you could take the idea that you could sell and rebuy if the price recovers and starts to move back up. Now, that's what a lot of people do. But what happens is usually when it recovers and moves back up, it moves quickly and you've lost out a lot of profit. Or each way, remember, especially if you're CFD trading CFDs, you have the buy price and the sell price. You have a spread. So you got to hope that you can get in at a reasonable price, cover the spread, because when you sold already, now you got double the costs and you might miss an opportunity. Or you could be like me. I set a target point. If I reach it, I'll move my stop loss all the way up. And maybe if it goes a little bit farther, but I'll take my profit and I'll be happy. I'll sell and permanently leave the market. If it starts moving back later, I will reevaluate a whole new fresh trade like I'm starting from scratch. But by properly identifying the movement as either a retracement or reversal, you can reduce costs, limit losses, and preserve capital. Now, traders have an expression for attempting to pick a market top or bottom. They call it trying to catch a falling knife. Now, if you're trying to enter the market, you've got no stake in it yet. You're looking to enter the market, and you're looking for an entry point. Well, you're never going to be able to enter or find the lowest point in that retracement to enter. So you need to decide at what price you're willing to enter the market, because trying to catch right where that retracement's meet or the lowest low or the highest high, you'll never make it. Okay. So as the expression implies, it can be downright dangerous and is not normally recommended. But seeing that retracement and saying, okay, I see it retracing and this is the low that I'm expecting to hit, the higher low, and I'll enter at that point. Well, if it becomes a reversal, you don't want to activate that trade, but if it bounces off of there, you want to be able to get in the market. But you want to get in the market above that lowest low that you had set. Because remember, retracements are very healthy. A trend that isn't doing well-defined retracements is not a healthy trend. It's not a good trade. The market in general can become tired of moving in the same direction. It takes a lot of work and money to send an asset to higher highs. When the price gets too high, buying pressure runs out when the money dries up. When demand dries up, price begins to fall and causes the charts to head south. This causes the security to become more appealing to prospective buyers who believe the stock or the asset has the potential to move higher. So if we're looking at a trend, price is moving up here, making higher highs, higher lows. Price is moving up here. Now it's moving in. At some point, the guys holding this trade that they entered here is going to say, okay, I've hit my target. I don't think it's going to go up any higher, and I'll sell. The guy also sitting on the sidelines is looking to enter that market, says, you know what, that price is too high for me to enter the market. I'm going to wait for it to retrace. So he's sitting on the sideline. This guy's exiting the market. So there's less buying pressure, so the price starts to ease down. When it eases probably to this point, you'll see buyers re-entering the market and fresh buyers coming into the market, which should drive the price to its next high. if you don't see volume increase and you don't see buying or the opposite selling, depending on which way the asset was moving, increase, then we're probably moving into a reversal. Now you can see that after a retracement, the healthy part of a trend, the asset was unable to push to a higher high. So we've got this retracement coming down, does a beautiful retracement. Move, push, move, push, move, push, move. And now it can't make, it's not being able to make a higher high. So it pushes up to where it was and then retraces back again. At this point, you know we have a problem. Whenever we can't form a higher high coming off of a retracement, we know that trend is in trouble. Okay. That's one of the ways we might see that we're moving into a reversal. But anytime that trend cannot make a higher high after retracement, we should be looking at exiting the market if we're in, or definitely not getting ready to enter the market, because we're looking for, at that point, a reversal. So reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal occurs. So here's the perfect example. Push, ease, push, ease, push. Ease is down and now it's not able to make a higher high. If this trend was going to continue, it should have been able to push up to there. But it didn't. It could not break that high. And what did it do? It reversed and moved into a downtrend. Now, there's no saying that it can't ease back down and regain its momentum. But at this point, we're saying to ourselves, we have some trouble brewing here. So again, you only have 3 possible decisions. So when faced with a retracement or reversal, you have 3 options. If you're in a position, you could hold on to your position. This could lead to losses if the retracement occurs to be a longer term reversal. You could close your position and re-enter if the price starts moving with your favor. Or 3, you could just close your position permanently. I'm not the kind of guy who always says, I could have made. You know, I got Bitcoin at 14.8 a couple months ago. Okay, I sold it all and closed all of my positions at 38.4. Now, I had nothing in the ride from 38.4 up to 57. Okay, but I wasn't crying. Yeah, I could have made more money, but I didn't even have a whole Bitcoin, so what's the difference? But the fact is, you could always cry over spilled soup. But the fact is, I made all the profit I intended and more in my initial trade. Why am I crying? I'm not. So the whole idea is never to say what could have been, what should have been, what might have been, and say, damn, I did good. And then from there, say, how could I set myself up so that next time I might be aware that it's got farther moved? In this case, I had set, I wasn't convinced of the 50,000 move. I should have moved up a trailing stop and just kept moving my stops closer, but I just got out of the market. I said 38.4, I'm happy. Now you have to be prepared because reversals can happen at any time. Choosing the best option isn't always easy. So how could we understand and see this? Well, Fibonacci retracements might help. When assets retrace 38.2, 50, 61.8 are good points that we should see. 61.8 should be about the last stop of a reversal. 50% is from Dow theory that an asset will tend to retrace 50% of its move. And 38.2 is the first line in Fibonacci. We also have support and resistance levels. I am a support and resistance trader. Now, we'll go back to Bitcoin and talk that again. Unfortunately, there are no support and resistance levels, or really no Fibonacci levels in Bitcoin, because it's at numbers it had never achieved before. So there's nothing that we can go back and say, the last time I was trading here. So you could look at trend lines and resistance levels. You could look at chart patterns. So let's go over to the live charts again. Let's take a look at what we could have looked at. Okay, so here we have the euro US dollar. We have our Fibonacci retracement tool on our charts. Okay. We saw price moving up. Look at what happened at this fib level. Came back down to the 61.8 retracement, moved back all the way up here to the exactly one, came back down now, and it's back at its fib retracement level. Okay, each one of these helped us make a decision along the way. We also saw something very unusual here. What happened? It wasn't able to make a higher high. It pushed up to this new high here. Beautiful. Retraced down a wee bit, but it's not able to come back up here. So right now we're saying this could be a sign of a problem, or this could just be a steeper reversal, and hopefully it's going to bounce off and continue upward. We haven't made a decision yet. We're not sure yet, but we're cautious. So as you can see here, we look for a complete reversal. Here on the right side, we can see that basically we can define this because we start making lower lows and we can't sustain those higher highs. I'm sorry, I'm hurting your eyes, I know. Now, there's something that we call FOMO. This is for people that are always worried about missing an opportunity. They're always chasing the market. They're always trying to define and say, I can do that. I can do this. I can do that. Okay. You need to make these decisions before you enter a market, and you shouldn't be making these decisions to help you make a market. Here we see the market is already overextended. So somebody who's always chasing an opportunity will jump in the market and short it here. But it wasn't a shorting opportunity. Then they go, got stopped out here again with a strong rejection, probably indicated a double top. They're always trying to jump in or out ahead of the market because they're always chasing. Their fear of losing out. They want to be in the first. But look at here. Here we had the perfect opportunity. And this guy who's been jumping in and out of trading positions missed it entirely. Now, we also need to be able to spot a breakout because we should get higher lows, higher highs, higher lows, higher highs, higher lows. And as we move up to that resistance level, we would see the asset trying to gather its momentum to break through that resistance level. And when it does with conviction, we know that we had a solid, good retracement. If it doesn't have that conviction, then we know there's a good probability it's going to move into a reversal. Because as you know, it might be that, yes, I draw this on a chart and say, yeah, this is what the market should look like. But in reality, it looks like this. But the fact is, in reality, we can find lots of opportunities and lots of assets that look just like this. And like I said in the beginning, this is a live chart. What do you want here? Everything is spelled out. Now you just need your support and resistance levels on the chart. You need some more information on your chart, but you see an asset moving perfectly exhibiting beautiful retracements, no signs of a reversal. You see a trend line supporting that movement, and you see push and ease, push and ease, push and ease, push and ease. And at this point, I'm looking for the price to really be a retracement and bounce off of this trend line. Now, without having my support and resistance lines on this chart, I don't have enough clues. But once again, we can see that right here. So we're looking at the Fibonacci retracement, and we're looking for price to bounce off here to move up and continue forward. And let's see what, come on. There we go. I'm just waiting for it to pop. There we go. Now you can see it in better detail. And you can see it now. We've used support and resistance lines on here. We've got a moving average. We see the beautiful push and ease, push and ease, push and ease, push and ease. And push, ease. And now this is our next secure resistance level or support level or price level. And this is where it's actually meeting the trend line. So we might sit back and wait for some type of reaction at the 121.84 level to see how the markets might move. Hopefully it's going to bounce off the 121.84 and continue its move up here to 122, maybe 123. But being able to see these, and like I said, these are real live charts. This is not some graphic I put together for you. This is my market evaluation, my technical analysis almost 24 hours ago at this point. And the asset was doing exactly what it was projected to do, how it was due, prices were doing. So if you sit down and look for the right assets, look for the well-defined trends, have your support and resistance levels, wait for that retracement, be able to evaluate whether it's a retracement or reversal, you can make successful, smart trading decisions. Oh, hold on a sec. So Fibonacci retracement tools are a great way to look at reversals and retracements. Trend lines will help you see. Chart patterns will help you see whether we're looking at a reversal or a retracement. Remember, technical analysis is a study of historical price performance in an effort to predict future price performance. Triangles are a great tool. So there are many ways to look for on a chart to see whether you're looking at a reversal or a retracement. There's a lot of ways we can use this to enter a trade successfully or exit a trade at the right time. But all we have to do is keep calm, enjoy our lunch, enjoy ourselves, and look for high probability opportunities where the actual asset is really trending. Believe me, there are more than enough opportunities out there for you. So thank you very much. If you want to learn more about retracements and reversals, go to www.alvexo and go to their education center, and you'll be able to find out all you need to know. Thank you very much for joining us today, and best wishes for successful trading.